While everyone was celebrating the latest EV announcements last week, a technical specification buried in Samsung's quarterly investor report just rewrote the future of the global metals market. And I'm not talking about lithium, I'm not talking about cobalt. I'm talking about a metal that most people associate with jewelry and old coins, a metal that's about to become more critical to the energy transition than oil was to the Industrial Revolution. What Samsung just confirmed in their latest solid-state battery roadmap represents the single largest demand shock for silver in modern history, and the market has absolutely no idea it's coming. Before we dive into the technical details, if you want to stay ahead of the biggest shifts in finance and technology, hit that subscribe button on Finance folder right now. We break down the stories that Wall Street won't tell you until it's too late. Let's get into this. Here's what happened. Samsung SDI, the battery division responsible for supplying cells to everyone from BMW to Ford, just published their production timeline for oxide-based solid-state batteries. The mainstream media focused on the sexy numbers: 900 miles of range, charging times under 10 minutes, energy density that makes current lithium-ion technology look prehistoric. But they completely missed the materials breakdown. Deep in the technical documentation, Samsung confirmed that their solid-state architecture relies on a silver-infused composite layer at the anode interface. Not a coating, not a trace element, an actual structural component that makes up a meaningful percentage of the cell's mass. Why does this matter? Because it fundamentally changes the economics of silver from a discretionary industrial input to a non-negotiable component of the global transportation infrastructure. Let me explain the chemistry in simple terms. Current lithium-ion batteries have a problem called dendrite formation. When you charge and discharge a battery repeatedly, especially at high speeds, lithium atoms don't deposit evenly on the anode surface. They form these tiny crystal structures that look like microscopic needles. Over time, these dendrites grow long enough to pierce through the separator membrane between the anode and cathode. When that happens, you get an internal short circuit. The battery overheats. You get thermal runaway. You get fires. This is the fundamental limitation of every electric vehicle on the road today. It's why fast charging damages battery longevity. It's why cold weather kills range. It's why manufacturers have to build in massive safety margins that reduce actual usable capacity. Solid-state batteries were supposed to solve this by eliminating the liquid electrolyte entirely. Replace the liquid with a solid ceramic or polymer, and theoretically, dendrites can't form. But here's the problem that's plagued the industry for 15 years. Even in solid-state designs, lithium metal anodes are chemically unstable. They react with almost everything. They expand and contract during cycling, creating cracks in the solid electrolyte. They still form dendrite-like structures at the atomic level that propagate through imperfections in the ceramic layers. Every major automaker has thrown billions at this problem. Toyota announced solid-state breakthroughs in 2014, 2017, 2020, and 2023. None of them reached production. Volkswagen invested heavily in QuantumScape, which has been promising production cells since 2019. Still not there. The technical barrier wasn't the electrolyte. It was the anode interface. Then Samsung's research team discovered something. They found that by creating a composite layer, mixing silver nanoparticles with carbon structures at the anode surface, they could completely stabilize the lithium deposition process. The silver acts as a nucleation host. Lithium atoms preferentially bond to the silver sites, which are uniformly distributed across the carbon matrix. This forces even deposition. No dendrites, no degradation. Stable cycling for thousands of charge cycles. The chemistry is elegant. Silver has nearly perfect electrical conductivity. It's chemically stable with lithium. It doesn't expand or contract significantly during cycling. And crucially, it works at room temperature without requiring exotic manufacturing conditions. Samsung's published test data shows cells maintaining over 95% capacity after 2,000 full charge cycles. That's basically the lifetime of the vehicle. This isn't theoretical research. This is production-ready technology. Samsung has already started construction on their first pilot production line in South Korea. They're targeting initial production volumes for 2027 with mass market scale by 2028. And here's where the math gets absolutely wild. Let's talk about how much silver we're actually discussing. A conventional internal combustion engine vehicle uses somewhere between 15 and 25 grams of silver total. It's in electrical contacts, switches, some circuit boards, nothing major. Current electric vehicles use more, roughly 30 to 50 grams, because of additional power electronics and wiring. This incremental increase is already putting pressure on silver markets. Industrial silver demand has been running a deficit of about 100 million ounces annually for the past 3 years, but we're not talking about adding 30 grams anymore. We're talking about adding silver as a core battery component. Based on Samsung's technical papers and patent filings, the silver loading in their solid-state cells appears to be approximately 5 to 8 grams per kilowatt hour of capacity. A typical mid-range electric sedan like a Tesla Model 3 has a 75 kilowatt hour battery pack. Let's do conservative math. 75 kilowatt hours times 6 grams per kilowatt hour equals 450 grams of silver. That's roughly 14.5 troy ounces per car, just for the battery. Add in the electrical systems, and you're looking at 15 to 16 ounces of silver per vehicle minimum. For larger vehicles, think Ford F-150. Lightning, with a 130 kilowatt hour pack, you could be pushing 25 to 30 ounces per truck. Now scale that globally. The auto industry produces roughly 90 million vehicles per year. Current projections suggest electric vehicles will represent about 40% of new sales by 2028. That's 36 million EVs annually. If even 20% of those 36 million vehicles use solid-state batteries with this silver-intensive design, we're talking about 7 million vehicles. 7 million vehicles times 15 ounces equals 105 million ounces of new silver demand every single year, just from automotive batteries. That's on top of existing industrial demand from solar panels, electronics, medical devices, and traditional automotive uses. Let's put that in perspective. Total global silver mine production is approximately 830 million ounces per year. That number has been essentially flat for a decade. Silver isn't like other metals. It's rarely mined as a primary product. About 70% of silver comes as a byproduct of mining lead, zinc, copper, and gold, which means silver production doesn't respond quickly to price signals. If silver prices double, zinc miners don't suddenly decide to mine more zinc just to get the silver byproduct. The production curve is inelastic. Meanwhile, existing industrial demand already consumes about 600 million ounces annually for solar panels, electronics, medical equipment, and water purification. Investment demand, people buying coins and bars, adds another 200 to 250 million ounces. We're already running a deficit of 50 to 100 million ounces per year. The market has been draining above-ground inventories to cover this gap. Now add 100 million ounces of structural automotive demand that's not price-sensitive because it's required for the battery to function. You can't substitute something else for silver in this application. The chemistry doesn't work with copper. It doesn't work with aluminum. It doesn't work with gold. It specifically requires silver's unique combination of conductivity, chemical stability, and electrochemical properties. This makes the demand completely inelastic. If silver prices triple, Samsung still needs the silver. The battery doesn't work without it. This is fundamentally different from traditional industrial uses, where silver is such a small component that price doesn't matter. In those applications, silver could go from $20 to $100 per ounce, and the end product price barely changes. But batteries are different. If Samsung needs 15 ounces of silver per vehicle, and silver is at $60 per ounce, that's $900 of silver cost per car. If silver goes to $120, that's $1,800 per car. For an automaker operating on 5% profit margins, an extra $900 per vehicle is catastrophic. So what's their response going to be? They're going to do everything possible to secure long-term silver supply at fixed prices. They're going to sign off-take agreements with miners. They're going to lock in forward contracts. They're going to potentially even buy equity stakes in silver mining companies to guarantee supply. And this is already happening quietly. If you dig through Samsung's recent supplier relationship announcements, there are some very interesting partnerships being formed with materials companies. They're not advertising it because they don't want to tip off competitors or spike prices before they've locked in supply. But the smart money is already moving. Here's what makes this situation different from past industrial commodity squeezes. This isn't gradual demand growth. This is a step function change. Solar panel adoption grew steadily over 15 years. Silver had time to adjust. This is more like what happened with palladium in the early 2000s. Automakers suddenly switched from platinum to palladium for catalytic converters. Because of cost and performance benefits, nobody paid attention. Then production ramped, and suddenly the auto industry needed 3 times more palladium than was available. Palladium went from $200 per ounce in 2001 to over $3,000 by 2020. Silver is setting up for an even more dramatic move because the deficit is larger and the supply response is slower. You cannot just dig more silver quickly. From discovery to production, a new silver mine takes 10 to 15 years minimum. If we found a massive new deposit today, it wouldn't produce a single ounce until 2038 at the earliest. The existing mines are struggling. Average ore grades have been declining for decades. In the early 2000s, a good silver mine might have 15 ounces per ton of ore. Today, 4 ounces per ton is considered excellent. That means you have to move 4 times as much rock, use 4 times as much energy, and employ 4 times as much labor to extract the same amount of silver. Costs are rising exponentially even as grades decline. And there's a political dimension that makes this worse. Mexico produces about 25% of the world's silver. The Mexican government has become increasingly hostile to mining, halting permits for new projects and imposing higher taxes and royalties on existing operations. Peru, another major producer, faces constant labor unrest and community opposition to mining. Russia, obviously sanctioned. China controls significant refining capacity, which creates supply chain vulnerabilities for Western battery makers. So precisely at the moment when Samsung's technology is about to inject massive new demand into the market, the supply side is constrained both geologically and politically. There's no elasticity, there's no relief valve. The only variable that can adjust is price. And here's where it gets really interesting from an investment perspective. The market hasn't priced any of this in yet. Silver spent most of 2024 trading between $22 and $28 per ounce. It rallied recently to the low 60s. But that move was driven mostly by monetary factors, inflation concerns, dollar weakness. The market is not pricing in 100 million ounces of new structural industrial demand. Financial analysts are still using outdated models that assume silver demand grows linearly at 2 to 3% per year. They're completely missing the discontinuity that solid-state batteries represent. This is your edge. Right now, you have information that the broader market doesn't have or hasn't processed yet. Samsung published these specifications, but they were buried in technical documents that commodity analysts don't read. The mainstream financial media is focused on lithium supply chains. They're talking about lithium mining, lithium refining, lithium hydroxide versus lithium carbonate. They're completely ignoring silver because it's not on their radar as a battery metal. Wall Street research reports about the EV supply chain mention lithium, cobalt, nickel, manganese, graphite. Silver doesn't even appear in the materials breakdown because analysts are still using old models based on current lithium-ion chemistry. By the time these reports get updated to reflect solid-state reality, the price will have already moved. So how do you position for this? There are basically three ways to play the silver supply shock: physical metal, mining equities, and derivatives. Let's talk about physical first. If you believe the Samsung scenario is real, and the technical data strongly suggests it is, then accumulating physical silver at current prices is the most straightforward strategy. But you need to be smart about what you buy. In an industrial squeeze scenario, weight matters more than numismatics. Collectible coins with high premiums are not the play here. You want the cheapest silver per ounce you can find. That means government mint coins like American Silver Eagles, Canadian Maple Leafs, or Austrian Philharmonics. Or it means buying bars, 10-ounce bars, 100-ounce bars, whatever gives you the lowest premium over spot price. The reason is simple. When industrial buyers are desperate for silver, they don't care if your coin has a pretty design or is graded MS70 by a certification service. They care about troy ounces of pure silver that can be refined into battery-grade material. The premium collapses relative to spot during an industrial shortage because the utility value becomes dominant. During the 1970s silver spike, rare numismatic coins actually underperformed bullion because smelters were paying above spot for raw silver to meet industrial orders. So maximize your ounce accumulation, minimize premiums, focus on weight. Second strategy, mining stocks. This is where leverage comes in. If silver goes from $60 to $120, the metal doubled. But a silver miner's profit might go up 5 times or 10 times because most of their costs are fixed. If it costs them $20 per ounce to mine, at $60 silver, they make $40 profit per ounce. At $120 silver, they make $100 per ounce. Profit increased 2.5 times, while price only doubled. That operating leverage translates to massive stock appreciation. But you have to be careful about which miners you own. There are 2 critical factors. First, you want pure silver miners, not byproduct producers. Most silver comes from lead zinc or copper mines where silver is just a small fraction of revenue. Those companies might see a modest boost from higher silver prices, but it's not transformative. You want companies where silver is 75% or more of revenue. Second, and this is absolutely critical, you want unhedged miners. Some mining companies sell forward production at fixed prices to lock in cash flow. If they hedge their production at $35 per ounce and silver goes to $100, they don't benefit. They're contractually obligated to sell at $35. The bank or buyer collects the difference. You want companies with zero hedges that sell every ounce at spot market prices. There's also a geographic consideration. The United States and Europe have passed regulations requiring battery materials to come from friendly nations to qualify for EV subsidies and tax credits. Silver from a mine in Nevada is worth more to Samsung than silver from a mine in an unstable jurisdiction because it keeps their supply chain compliant and secure. Mines in safe jurisdictions, Canada, US, Australia, will trade at a premium. There's also the possibility that battery manufacturers start buying stakes in silver miners to secure supply. If Samsung or LG announce an investment in a junior silver miner, that stock could triple overnight on the news. Third option, silver futures and options. This is the most aggressive play and carries the most risk, but also the most potential return. If you believe the Samsung catalyst is going to drive prices significantly higher in the next 12 to 18 months, out of the money call options on silver futures offer massive leverage. But you need to be careful about timing and position sizing. The paper silver market on exchanges like COMEX is notorious for volatility and manipulation. Large banks can, and do, suppress prices short-term by flooding the market with paper contracts. You might be right about the long-term direction, but get stopped out by short-term volatility. If you're going to trade derivatives, use a small portion of your capital and be prepared for dramatic swings. Let me be clear about something. I'm not saying silver is going to $10,000 per ounce next month. I'm saying the fundamental supply-demand dynamics have shifted dramatically, and the market hasn't recognized it yet. The Samsung solid-state battery technology creates structural demand that didn't exist before. This demand is non-negotiable, it's not sensitive to price, and it's large enough to consume a significant fraction of global supply. When the market fully understands this, when other automakers announce similar battery chemistries, when the first solid-state EVs start rolling off production lines and people can actually see the silver content in the spec sheets, that's when the repricing happens. There's a historical parallel worth mentioning. In the late 1990s, digital cameras started replacing film. Kodak and Fuji dominated the film market, which consumed about 30% of annual silver supply for photographic applications. Everyone assumed digital cameras would crash silver demand. And for a few years, photographic silver use did decline. But simultaneously, solar panels and electronics demand was ramping. Then in 2008, the first iPhone launched. Suddenly everyone needed a smartphone with silver paste in the touchscreen. LED lighting took off, all using silver contacts. The decline in photographic silver was more than offset by growth in other applications. Silver demand actually increased even as its largest historical use case disappeared. We're seeing something similar now, but in reverse. Traditional industrial uses are stable or growing slowly. But now you're adding an entirely new category of demand that's larger than all previous growth combined. Battery silver could become the single largest use case for the metal within 5 years. And unlike photographic silver, which was eventually replaced by digital technology, battery silver has no substitute on the horizon. The chemistry is what it is. You can't cheat the periodic table. There's one more angle that's crucial to understand. Government policy. Every major economy has committed to electrifying transportation. The European Union, California, several other states have announced bans on new internal combustion engine sales starting between 2030 and 2035. China has aggressive EV adoption targets. These are legal mandates, not market predictions. Governments have bet their climate credibility on this transition, which means if silver becomes a bottleneck to EV production, governments will intervene. They might declare silver a strategic material. They might invoke defense production acts. They might restrict silver exports or limit non-industrial uses to ensure battery factories have supply. In a crisis scenario, governments prioritize industrial allocation over retail investment. If you think this sounds far-fetched, look at what happened with medical equipment during COVID. Governments commandeered supply chains, restricted exports, forced production priority. If EV production is threatened by silver shortages and politically committed climate goals are at risk, you can absolutely expect similar interventions. This creates a strange dynamic for silver investors. On one hand, the shortage drives prices higher. On the other hand, if prices go too high too fast, it might trigger a regulatory response that limits your ability to profit. This is why physical possession matters. If you own the metal directly, it's harder for regulators to confiscate or restrict compared to paper claims or mining stocks. I'm not trying to be alarmist, just realistic about how governments behave when critical industries face supply constraints. So where do we stand right now? Samsung has confirmed the technology. The production timeline is public. The chemistry is published science, not speculation. The demand math is straightforward. The supply constraints are real and well documented. The market hasn't priced this in yet. If you're watching this video from Finance Folder right now, you're early. Most investors won't hear about this until Samsung starts shipping batteries in 2027, and suddenly analysts realize there's a massive new source of silver demand nobody accounted for. By then, prices will have already moved. The opportunity is now, while the market is still focused on other narratives. I'm not a financial advisor. This isn't investment advice. Do your own research. But I am telling you that the technical fundamentals have changed dramatically. And if you understand chemistry and supply-demand dynamics, the implications are clear. The banks can suppress paper prices short-term. They can create volatility. They can trigger margin calls and shake out weak hands. But they can't change the laws of physics. Samsung needs silver for their batteries to work. The auto industry needs Samsung's batteries to hit range and charging targets. Governments need the auto industry to meet climate mandates. This chain of dependencies creates inelastic demand meeting inelastic supply. Something has to give, and that something is price. We're potentially looking at a multi-year bull market in silver driven by real physical demand, not just monetary inflation or speculation. This is industrial consumption that removes metal from the market permanently. When silver goes into a battery that lasts 15 years, it's sequestered. It's not coming back to market. Yes, eventually batteries get recycled, but that's a decade and a half away. The silver going into 2027 model year vehicles won't re-enter supply until 2042. The recycling wave people talk about as a source of future supply, it doesn't help with the shortage happening right now. In fact, it makes it worse because it locks up metal for years. So here's my challenge to you. Go read Samsung's technical documentation yourself. Look at their patent filings. Search for publications about silver carbon composite anodes. Check the chemistry. Verify the numbers I've given you. Don't take my word for it. Do the research. Then look at current silver prices and ask yourself if the market is correctly pricing in 100 million ounces of new structural demand starting in 2 to 3 years. If you conclude that it's not, if you see the same supply-demand imbalance I'm seeing, then you have a decision to make. Do nothing and watch from the sidelines. Or position yourself ahead of what could be the largest commodity supply shock of the next decade. The Samsung solid-state battery changes everything. The silver market will never be the same after this technology scales. The question is whether you recognize it before everyone else does. If you found this analysis valuable, make sure you're subscribed to Finance Folder. We're covering the financial implications of technology shifts that mainstream media completely misses. Hit that like button, drop a comment with your thoughts on the silver situation, and I'll see you in the next video where we break down the next big story Wall Street isn't telling you about.